Good morning, everybody, and welcome to the weekly analysis session for the Elite Traders Club on this Monday, the 6th of July 2015. Already past the halfway mark into the second half of the year. And let's see what's happened over the course of the weekend. We've had, what did we have in Greece? We had a referendum, and the Prime Minister over there giving the power to the people, the home of democracy, deciding whether or not they were going to accept the bailout conditions from the Eurozone, from the IMF, and they've decided, seems like about 60% of the population have said no, we don't want a piece of that. We want to try and come up with some other arrangement. So I'm not too sure where that's going to go at the moment. It looks like the futures are down a little bit. But anyway, let's go and have a bit of a look at what's happened over the course of the weekend. Just a reminder, we do have the Elite Academy coming up at the end of August. So again, if you've got space in your diary, certainly love to see you there. A great program, some brand new material, a great venue. So certainly more than happy to see you there. And indeed, I encourage you to come along and extend your learning. Right, the disclaimer for today: the content of this presentation or any other Elite Traders Club material does not constitute a recommendation, nor does it take into account your investment objectives, financial situation, nor particular needs. So before making an investing decision based on the general advice presented in any of the Elite Wealth presentations, please consider whether the advice is appropriate in light of your financial circumstances. Today we'll go through and have a look at some of the portfolio management concepts, in particular having a look at if there are any new setups. Last week you may have realised with your Beyond charts that because of the shortened week in the US, a lot of charts we didn't actually get a weekly candle forming. So those of you who tried to do some scans over the course of the weekend may have ended up with mixed results. I certainly did. In fact, I ran a scan that had a combination of the previous week's setups and probably about 70 odd setups for the current week, where some charts had actually formed a weekly candle. So go figure that one out. I'm not too sure. But anyway, we can only do what we can do. So let's go through and have a look at where we're sitting in terms of our market risks at this point in time. Certainly in the Australian market, we are now in very high risk. So our stochastic on the benchmark has now dipped below 40, so it's between 40 and 20. So that's putting us into a very high market risk mode, in case you didn't already know. As such, we have to use a 20% market risk multiplier. So that just means that you need to apply a 20% factor, if you like, or multiplication of your maximum allowable drawdown, which for most of you is around about 15%. So 20% of 15%, a fifth of that, is going to have your net exposure at around about 3%. So really tightening the reins. Interesting, just been having a bit of a look at the Australian portfolio at the moment, those stocks that are in the watch list. And interesting that last week we didn't get any stop outs. We certainly didn't get any opportunity to trail any stops. But some of the stocks there still continuing to hold up reasonably well given where the market risk is at the moment. So again, just the virtues of relative strength. If the market does happen to turn around anytime soon, then I'm sure those stocks that are still above water are going to return to the performing side of the ledger. At this stage in the US market, the stochastic has just dipped below 80. It's taken a while to get there, and as such, it's putting us into a moderate risk market over there again, feeling certainly not moderate, but a little bit higher than that. And as such, market risk multiplier of 80%. So if you had a 15% maximum allowable drawdown in your US portfolio, you are now have to apply an 80% market risk multiplier. So 80% of your 15 will bring you back to a 12% total value at risk on your US portfolio. As you'll see there in the Australian market, very high market risk at the moment. This is assuming that if you are indeed splitting your portfolio between the Australian market and the US market, therefore your Australian component would only have 1.5 or 1.5% value at risk. allocated. Conversely, the US portion of your portfolio, the other half, in this particular example, would bring you down to 6% value at risk. So again, this particular model portfolio is assuming that you are splitting your capital allocation between both Australia and the US. Because we are in very high risk mode, those of you who are still choosing to scale out, you're looking for one-to-one type targets. Those of you in the US, because we are in moderate risk, if you're choosing to scale out, you are looking for 2-to-1 type targets. Very interesting concept, the idea of scaling out with different levels of market risk. Certainly there are a number of trades in the US that are still performing unbelievably well given what's going on around the world. And certainly if you were looking to take profits along the way, I think you'd probably be finding yourself out of some of those trades. And if the market does happen to bounce back at any time soon, then those trades are going to go on to bigger and better things, one would imagine. All right, so I think we should go and have a bit of a look at what's happened on the market with respect to Beyond Charts. And as you'll see, I've got up there the S&P 1500 hour benchmark index that we use in the US. Now, typically I use candles, is my preferred measure on the charts, but you'll see there that I've currently got bars, and the reason for that is that Beyond Charts has been doing a couple of strange things to me over the course of the weekend. So I did a little bit of resetting, and for the time being, it doesn't want to put candles on my chart. Hence, I've got the bars there. So it's not something I would normally do, but that's the explanation for it there. As you'll see, the stochastic there in the US market dipping below 80, so now between 80 and 60, and certainly putting us in moderate risk. Again, this market has really, of the last probably 2 months in particular, really gone very much in a sideways type of move. So if we think about what's happened through here, it's just a matter of whether we're going to remain within this range or whether we're going to see more downward price action. So given what's happened in Greece, again, I expect it to be fairly volatile. The VIX has had a big spike in the last few days. So certainly the volatility is on the increase, but that's not a surprise for those of you that have been watching the market as part of ETC. So that's where we are on the US markets. Let's go and have a look at where we are on the Australian market. You can see for quite a period of time now, we've really been in this extended downward moving market, and we've really struggled for, a period of time to break out of this particular range. Just no sooner do we get up near the top of the market and the market is pushed back down. And we were commenting the previous week that we had this classic 3-bar reversal at the top of this type of range, only to sell off pretty hard down towards the bottom, getting back up the top there and rejecting again. It looks like being at this stage probably a little bit of a down day on our markets. The US futures at this stage are down about 1% as we speak. I thought it'd be interesting just to go around and have a look at some of the other markets around the world, given the context of what's going on globally. The Nikkei, again, performing very, very strongly still, given what's going on in the world, and still maintaining an upward trajectory. That's the Chinese market. Wow, what a volatile market this has been. Nice, low volatile move up here. Look at the size and the range of the bars. And then as we get to the top, and we have a number of dramas in terms of the capital requirements, etc., margin lending, overhauls, all those sorts of things in the Chinese market, we start to get range expansion, volatility really increasing, and volatility again increasing, and some very big moves last week, moves up and down of 5, 6, 7% in either direction. So certainly a market that is probably well worth steering clear of at this point in time. The Nasdaq, again, being very weak, a lot of red candles in there of late. Typically, this has been a market that has tended to pull the other markets up over more recent times. Any other ones on the list there? This is the Dow again. Whilst this is not our benchmark, this has really been in a very much a sideways regime for quite a period of time. It's now really testing the bottom stretches of this range. If we do happen to break out of this, then we've got a downward sort of target back to previous points of demand, back at the beginning of the year. So things not looking all that rosy as we speak. Might just go and have a look at some of the currencies just for a bit of interest's sake at the moment. The euro, there we go. Let's just make sure that we're on a daily chart at this point in time. The euro's obviously been on a steady downward move for a period of time. It has recently tried to move back up, and that was more on the basis of some US dollar weakness. The US dollar certainly has over the last couple of weeks been gaining some strength. I'm surprised not to see this down a little bit more at this particular point in time, but this upward type of trend at the moment looks like it might be starting to move down a little bit lower. So if we just go through and put on a bit of a swing chart there for the time being, we've got these higher, longer term peaks. Just more recently starting to put in a medium term downtrend. Interesting to see whether this sort of upward angle holds or whether we start to roll over more to the downward side. Let's go and have a look at the Aussie dollar. Spell it properly, David. AUD, USD. And you'll see we've had an extended sell-off for a period of time where the market went down to around about 75 a couple of months ago, and since then it has tried to bounce back up towards the 80 level. And again, pretty classically, these old zones of what were once demand now starting to act as zones of supply. Price coming back down over the course of the last week, really being hit pretty hard. Friday's candle being very big and very bearish. Remembering last week on the Thursday, I think it was, we had retail sales which were very disappointing. About the only things that were selling in shops were things like jewellery and a few little personal items, but nothing really significant. So perhaps the market there forecasting that the RBA may be looking at lowering interest rates in the not too distant future, hence the Aussie dollar selling off pretty heavily there. I think Glenn Stevens will still keep his cards pretty close to his chest and wait and see what happens on the jobs front for the time being. This is an example of the scan that I ran on the weekend, and you'll see that the signal date on a number of these has the 2nd of July. But if we continue down the list, that soon gives way to the 26th of the 6th, which was a previous week's scan. So what I did this current week was I just went through those particular setups that happened to be in this particular scan from the 2nd of July. Went through all of those, and as per usual, just going through one at a time, putting on a swing chart, and again, just checking out the last trough and seeing where that is in proximity to the second from last peak, and then just going through them one at a time, looking for specific setups. And then if there was any such setups, checking for longer term peaks, overhead points of supply that might get in the way. But I didn't even have to get that far because there was insufficient price action that passed the price action filter. So this week in the US, there were no new setups. However, there were quite a number of cancellations. And what I might do here is just bring over. At this point in time in the US, last week there were quite a number of new trade setups. And now just about every single one of those trade setups has now been cancelled. So if you go through and check the actual watch list, you'll see why all these trades have been cancelled. So a lot of them is purely because the price action has deteriorated, and it's not surprising given the action in the markets the last couple of weeks that a number of stocks have started to struggle. So make sure you check the watch list there in the US for any of those orders that have now been cancelled by virtue of deteriorating price action. There were 6 stop outs last week. So again, we just need to go through and see whether or not we've got any stops being hit. So as an example, ADP, previous week converting a soft stop into a hard stop, and as a result of the price action last week, that hard stop being hit and therefore closing the trade. So just make sure you check the watch list for any breaches of soft stops where there might be soft stops now being converted to hard stops. So there were 6 stop outs. As I mentioned, 33 cancellations, no new setups. There were, however, which is really interesting, there were 16 trailed stops. So if you go through the watch list, and you'll see the dates, the entry points there, and the stops, the protective stops being trailed. So again, just showing the merits of relative strength as well. So even though the market's teetering or moving more towards the downside than the upside, we've still got stocks that are moving in a positive direction, and certainly that's all got to do with money flow into those stocks. Really good relative strength. They've got some momentum underway, and it's a good trait to have in the stocks that you are investing in. In the ASX, by comparison, in fact, I'll just go back to that USA list just for the time being, because I just wanted to show you that there are still a number of stocks that are pending. So AAN is still pending, and so is AEIS. That one there should be a order cancelled. So just check that one on your watch list. AEIS is an order that needs to be cancelled. However, further down the list, we still have TWC Media, which is still holding up, and price action hasn't deteriorated, so that is still a valid trade setup. In the ASX, the previous week we had Transurban. That was from the week before that was stopped out, and same with Sydney Airports. Other than that, all the other trades are still live and valid. We haven't had any further stop outs from the previous week, so that's a good sign for those stocks in the portfolio. Again, hopefully if this market can turn around anytime soon, that those stocks, again, with good relative strength, will turn around to the upside. We had a setup for the previous week, AP Eagers. That's still a valid setup. Price action hasn't deteriorated on that one for the time being. So I thought what we might do is just go through and have a look at some of the setups from last week, and just go through some of the explanations of why they've now been cancelled. So I've got a pendings list from last week, so I'll open that up and we'll have a look at those setups. All right, so AAN is still a valid setup, and you'll see that it looks a very strange chart on here, because over the course of the weekend, Beyond Charts was being a little bit difficult, and as such, I wasn't able to keep my candles, and you'll see that as a result, all I've got are black candles. So what I'll have to do on this one, change my chart type to a bar chart, and that's now at least got up candles and down candles, or up bars and down bars per se. At this point in time, this was our last candle. During the course of last week, we had an inside candle form, so we're still short-term uptrend, and this is still a valid setup. So for those of you who do need to put another trade into your portfolio, I dare say that would be very few of you. It's still a valid setup. The next one, looks like I'm going to have to do this for all of the ones I'm looking through. This order has been cancelled, so let's go through and have a little bit of a look as to why. Previous candle, we certainly had a short-term uptrend, therefore confirming that we had a new medium-term trough in place, which was well above the second from last peak. However, during the course of the week, we've had a rather bearish candle, and as such, we've now got a lower high and a lower low, so we're now in short-term downtrend, and as such, that means that we've had a lower peak formed. Okay, so hence the price action. If this is going to turn around and move to the upside, again, remember our price action filter. We are looking for that the last trough is at or above the second from last peak. So if this does, in fact, turn around and move upwards this week, this new trough that is forming, is this going to be at or above our second from last peak? No, it's not. And so therefore, it fails our price action filter. So again, having to go through and change my chart type. I won't go through all of these. Really just wanted to point out to you that on a number of them we've had lower peaks formed. So as such, again, not meeting the price action filter. This was the one that I was commenting on in the watch list. This one actually needs to be cancelled, so I'll have to go through and amend that, but just for your own records, just make a note of that one in case you were looking to add that to your portfolio. I won't go through the rest of them rather than having to change those candles back to bars, but there's, as I said, there's around 33 cancellations in the US for the time being. What I thought I might do at the same time, given that we didn't have any new setups in the US or the Aussie market this week, is just go through and have a look at some of the open trades. Again, this is going to be a little bit frustrating because Beyond Charts is just being a little bit challenging at this point in time. Blackstone there for the time being has, if we just move in a little bit, was triggered in, obviously during market conditions recently, just managing to hold on at the moment. Good thing last week at least is that it had a more up candle than the previous week. AYI chugging along pretty nicely here. Nice candle last week. The 3 ATR just about coming up to the initial stop, the initial 2 ATR stop at the moment. So again, that's a positive sign, particularly in light of present market conditions. DOX struggling a little bit on this one. Chart type here. Again, we've had a number of price volume volatility signals going off. So what typically happens with these candles is more often than not you get the price volume volatility being associated with more of a bearish candle than anything, and price extension as well. A little bit unusual to see these price volume volatility signals going off on what are sometimes some bullish candles, but nevertheless it's still holding up reasonably well, again, given what's happened with the rest of the market. ANTM, just have a quick look. Again, holding up, price volume volatility signal. Since triggering, you'll notice that the 3 ATR now is above its initial stop. So hopefully this can turn around. It's done a fair bit of work since then. A nice bit of price movement up here, dragging that 3 ATR up. So that's a good sign for that particular stock. AWH moving along quite strongly at this point in time. Again, 3 ATR coming up past our initial 2 ATR soft stop when we're first setting up the trade. So that's a positive sign for the stock. It's now established itself with a good distance to its stop. So it's giving it every opportunity for this stock to really do its thing and move in the right direction. And given the volatility that we've had the increasing volatility we've had in the market recently, having that wider stop now is certainly going to help this particular stock now that's done the hard work. So if that can hold on, then it looks pretty strong. Delphi Automotive got off to a good start. Since then, has had a little bit of a pullback the last couple of weeks. Again, trailing 3 ATR starting to come up a little bit now, so that's a good sign as well. And CBPO, sounds like the Star Wars character there. Initially entering in, you might remember, back around about the early May, got off to a flyer, moved up, prices come back. Since then, prices started to move up. So along the way, as price started to come up, it dragged the 3 ATR up. So in that first initial boost, since then, price did move down, didn't close below its trailing 3 ATR, so that's a good sign. Prices started to move back up, and last week not being too bad a candle. Certainly the 3 ATR is now well above our initial stop on the trade, so again, another positive sign for the stock. Now, I won't go through all of these, but I think it's worth just going through and revisiting the portfolio from time to time. I know that a number of stocks have been stopped out, But I think it's important to have a look at those stocks that are still part of the portfolio and just see how they're performing against the backdrop. Now, this is one of the things that you're going to experience with your trading. You don't know which of any of these entries over the past, couple of years, as an example, are going to be the ones that are going to really boost the returns on your portfolio. So you've got to take the good with the bad. But the important aspect of it is managing that initial risk in your portfolio exposure, but at the same time, giving your stocks every opportunity to move in the right direction. And if you do that, then you're going to have some stocks that just go on and on and on and on, and really make a massive difference to your end outcome. So, your job really is just to follow your rules, keep it as simple as possible. The market's going to do what the market's going to do, but if you keep it simple, then you've got the best chance, I believe, of achieving some really good outcomes. All right, guys, I'll throw it over to you. Has anyone got any questions, as an example, that you might like to put forward, or any charts that you might like to have a look at? Certainly happy to have a look at anything at this point in time. Questions? Stocks? No questions? That's all right. If you haven't got any questions, it's not a bad thing. There's not a lot of things to do on the market this particular week. Again, just remember to make sure that you're on top of your risk, making sure that your portfolio management is up to speed. If you're having any troubles with any of that, then certainly give your ETC coach a call. But other than that, we'll leave it there for the time being. Interesting to see what happens in the wake of this Greece referendum. For the time being, will be interesting to see what's going to happen with the rest of the market. Ken Verrill says, how to stay calm on the ASX. Well, it's just the same as any other time there, Ken. If you feel worried, it just means that you may have a little bit more risk in the market than perhaps what you're comfortable with, and that's something that investors and traders have to grow into and feel comfortable with. The Australian market at the moment, let's go through, and I might just, for that point of view, have a look at the Australian trades at the moment. So the weekly opens, and again, a little bit problematic here in terms of the charts, but holding up reasonably well. So AHD, even though our market has moved to the downward side over the last, if you think about it, the last few months, this stock has been able to maintain its current price level. So again, look at the relative strength. So don't worry too much about what the rest of the market's doing. That's why we have a market risk indicator to tell us whether we should be reducing our exposure. And one way to do that, don't forget, is you don't necessarily have to sell your entire portfolio, but you can sell portions of a holding. So rather than necessarily trail up stops, which is just inviting a stop out, if you choose to sell potentially, let's say, half your position, then therefore you are also at the same time reducing your value at risk, but importantly still maintaining exposure to those stocks that are exhibiting good relative strength. And you've only got to look at the stock like this, how well it's been and how long it's been outperforming the broader benchmark. So that's your job as an investor, is to go through and just make sure that, I don't know whether that's going to come up for me or not. You can see what's happened on my chart there. That's CZZ, and Beyond Charts playing funny games with me and not wanting to show that. So I'm not too sure why. But this is a stock that, again, despite what's been happening in the market, look at the relative strength of this particular stock. And that's why you're on the Elite Traders Club. That's why you have these scans. And that's why they're gold in terms of pointing you in the right direction, at least allowing you to become aware of those stocks that are exhibiting that really solid relative strength. So that's the important thing. Keep it simple. Make sure you're on top of your portfolio management, on top of your position sizing, and the rest of it's up to the market. Stay relaxed. Don't panic. You're an investor, you've got your rules, just stick to it and keep it simple. Right, guys, I think we'll wrap it up there. Let's catch up again on Monday today week. We'll be doing an education session this week. It will be a live one. We'll go through and revisit some of the stocks in the portfolio and talk about some of the concepts of relative strength and the importance of such, particularly during these times. So have a good week, and we will catch up with you hopefully on Wednesday afternoon for the live education session. Bye-bye for now.